So, what we were
Hello,
covering?
sir. Assalamu alaikum.
Walaikum assalam, Habibi.
Sir, actually, I'm taking just law in this June classes. I'm not taking FR.
Uh-huh.
I'm
So
not
you're
taking
not in
FR in
FR.
this.
Okay,
Yeah,
okay, leave the meeting, leave the meeting, enjoy life then.
thank you.
Okay. Financial reporting. In previous week, we started the chapter 2 about tangible non-current assets. And there are 4 accounting standards in this chapter. One is IAS 16 that we have covered so far. IAS 20 government grants that we have covered so far. And there are 2 more accounting standard left. One is IAS 23 borrowing cost that we will cover today, and IAS 40 investment property that we will cover today. And then we will be able to finish this chapter. Then we will practice some questions relating to these 4 accounting standards and we'll move forward. So IAS 16 property, plant and equipment we have covered. We have covered this dismantling cost in previous class. If there is any dismantling cost, we need to capitalize, but how? Using present value method. So IAS 20 government grant we have covered. There are 2 types of grant: revenue nature, capital nature. What is the treatment of revenue nature? What is the treatment of capital nature? We have covered so far. So let's move towards a new accounting standard, that is IAS 23 borrowing cost. Borrowing cost. What is meant by borrow? Borrowing cost means cost of borrowing. What is cost of borrowing? Cost of borrowing. Borrowing cost means cost of borrowing. If we borrow some money, we need to pay the money that we have borrowed, as well as we need to pay some amount over that money. The amount that we are paying over that loan money is called borrowing cost, mean cost of borrow. In simple word, interest. Interest. If we have taken a loan and that loan is relating to any of the asset construction, so we need to capitalize the interest of that loan in asset cost. If in a business we have taken any loan from the bank, this means we are paying interest on that loan. Normally we show interest as expense in profit and loss account. But if the loan is used in asset construction, the amount of loan is used in asset construction, we need to capitalize the interest on loan in asset cost. Say, suppose. So this is a time period. Suppose this year started on 1st of January 2023, ended on 31st December 2023. And after that, the next year. So in this time period, we took a loan from the bank about 10 million at the rate of say 10%. Mean 10% is the interest rate. This means we need to account for interest of this loan amount. If 10 million is the total amount, 10% is the annual interest rate. This means every year we need to charge how much? 1 million interest. Normally we charge interest in profit and loss account. But if we have used this loan in construction of the asset, then we will capitalize this interest, mean we will charge as asset cost rather than profit and loss account. But if suppose this is our year end at this point, like 1st of March 2023, we started construction of the asset. Construction started. And we completed the asset construction on, say, 30th of September. Construction completed. So the complete year loan amount is 1 million. Interest amount is 1 million. This loan amount is used in asset construction as well. And for the complete year, interest expense is 1 million. We can say 1 million as like this. Out of this 1 million, how much should be expense out in profit and loss account? How much should be added to the asset cost? We need to see when asset construction started at 1st March, when it is completed on 30th September. So for that time period interest, we need to capitalize in the asset. And for this time period and this time period, interest should be recorded as expense in profit and loss account. How many months during construction? From 1st March to 30th September. March, April, May, June, July, August, September, 7 months. This means out of this 1 million, 7 by 12 should be capitalized. And remaining 3 months this and 2 months this, or 2 months this. These 2 months and these 3 months. So remaining of 5 by 12 should be recorded as expense in profit and loss account. IA 16 property, plant and equipment says all the cost incurred from start of construction of the asset till the date construction is completed should be capitalized, including borrowing cost. This means if there is any borrowing cost that is relating to asset, we need to capitalize in the cost of asset. But before construction date, the interest should be expense out. After construction of the asset, if there is any interest, that should be expense out because these are not relating to the asset. Can you understand this? So for the complete year, interest is 1 million. How much should be capitalized? From the date asset construction started and the date asset construction completed. For that time period, interest should be capitalized. And for the remaining part of the year where no asset construction work carry out should be expense out. This is the concept of borrowing cost. Mean borrowing cost interest normally we need to record as expense in profit and loss account. But if it is relating to the asset, meaning we use the loan in asset construction, then the loan interest relating to that asset part should be capitalized in the asset cost. Can you understand this concept? Okay, one concept. Now moving towards another concept. Suppose we took the loan for 10 million. And out of this 10 million, 7 million we used for the asset construction in the current year. And remaining 3 million was surplus cash with us. So out of this 10 million, the remaining 3 million we invested somewhere. Where we invested, either we deposited into the saving account and generated interest, earned interest, or we invested into any building and we earned any rental income from that investment. This means against this 3 million, suppose we generated the income about 0.5 million. Mean this much we generated the income. And this is the income for the whole year. as we are charging some part of interest to the asset cost, this means this income is generating from that loan amount. So suppose if 7 by 12 of 100,000, what is 7 by 12 of 100,000? Can you calculate, please? 583333. 58 four threes or five threes? Four threes. So this is the amount that we need to capitalize. This is the amount that we need to capitalize. And if we have generated any income out of that loan part, that is a 500,000 for the complete year. This means out of this 7 by 12 should be deducted from this amount, and with the remaining amount we should capitalize in the asset cost. Because this 10 million alone we took, and we used some of the amount in current year, but remaining surplus amount we invested somewhere, and we generated some income from that part. That income should be recorded in a profit and loss account as other income. But as we are capitalizing interest expense, means some part of interest to the asset cost, in the similar manner, the income generated from the amount of loan should be deducted from that cost, and the remaining cost should be capitalized. So this 5 by 12 expenditure should be recorded in profit and loss account, and out of this 5 by 12 should be recorded as other income in profit and loss account. Can you understand this concept? If we have taken any loan and that loan used in construction of the asset, so the interest amount relating to that construction period of the asset should be capitalized, should not be expense out, should be capitalized in asset cost. And the interest amount other than the asset construction period should be expense out in the profit and loss account. And if out of that loan amount, we use some amount in the current year and the remaining amount we might need to use in coming years. So that was surplus with us. So we invested somewhere and we generated any income on that loan investment amount. So that income should be deducted from the borrowing cost. And with the remaining amount, borrowing cost should be capitalized or treated as expense in profit and loss account. Let's read what this standard is saying. IS 23 borrowing cost regulates the extent to which entities are allowed to capitalize borrowing cost incurred on money borrowed to finance the acquisition of certain assets. Borrowing cost must be capitalized as part of cost of an asset. If that asset is a qualifying asset, mean amount is used in asset construction, one which necessarily takes a substantial period of time to get ready for its intended use or sale. Commencement of capitalization mean when borrowing cost should be capitalized, mean up to how much period borrowing cost should be capitalized. So borrowing cost should be capitalized from start date of construction of the asset till end date of construction of the asset. Borrowing cost before start construction date should be expense out, and borrowing cost incurred after the construction have completed should be expense out. So commencement of capitalization, IS 23 states that the capitalization of borrowing costs should commence when all of the following conditions are met. Expenditure for the asset is being incurred, mean that loan amount is used in asset construction. Borrowing costs are being incurred. Just give me a moment. So when the borrowing cost should be capitalized, if the amount of loan is used in asset construction and borrowing costs are being incurred, mean business need to pay the interest. So activities that are necessary to prepare the asset for its intended use or sale are in progress. And business is using that asset. The rate of interest to be taken where funds are borrowed specifically to acquire a qualifying asset, borrowing costs which may be capitalized are those actually incurred less any investment income on the temporary investment. In how cost should be capitalized, the interest expense for that time period, construction period, less any investment income. Mean if you invested that some part of the loan somewhere and you generated some income, so we need to deduct that income from the cost, and remaining amount should be capitalized as borrowing cost in asset cost. So test your understanding 6. Wilson received an 18 billion 5% loan on 1st January 20x8. So 1st January 20x8, company received 18 million loan and the interest is 5%. This means what's the annual interest rate? If we calculate figures in thousand into 5%, what's the annual interest rate? Figures in thousand. 900. So this is the complete year interest. To finance construction of a new factory. This means this loan is being used in construction of new factory mean asset. As the funds were not all required immediately. So Wilson invested 6 million out of this 18 million in a 2% bond until 31st May 20x8. This means company invested how much? 6 million into 2% rate. How much is that? 12.
120.
12. They generated 120. Okay, 120,000 investment income. And they invested it until 31st May 20x8. They invested until 31st May 20x8. Construction of the factory began on 1st March 20x8 and was completed on 31st December 20x8. So construction started when? 1st March 20x8 and construction completed when? 31st December 20x8. This means for the complete year amount should be capitalized, but we need to deduct any investment income from this amount. So what is investment income? That is 120. So if we deduct 120, so remaining should be capitalized. So calculate the amount of interest to be capitalized in respect of the factory as at 31st December. Is that fine? Mean the complete year used in construction. This means for the complete year interest amount should be capitalized. But we need to deduct what? If there is any investment income they have generated. So 900 minus 120. How much should be capitalized?
780.
780,000. Is it fine? Okay, let's move forward. Where funds for the project are taken from a general borrowing, the weighted average cost of general borrowing is taken. If there is no one loan, there are more than one loans. Like Here we applied a 5% interest. I mean, borrowing cost is 5%. But if there are so many loans, how we can calculate the interest rate? Suppose if an entity had a 10 million 6% loan and a 2 million 8% loan, I mean there are two amounts of loan having a different interest rate, the weighted average cost of borrowing would be, then we need to calculate the weighted average rate. How? 10 into 6 is equal to what? 60. 2 into 8 is equal to what? 16. Altogether is a 76. How much is the amount of loan? 12. So 76 divided by 12, the rate will be 6.33%. That will be borrowing cost interest rate that we need to charge. If there is one, we can use that interest rate. But if there are more than one general loans, so the cost of borrowing will be calculated using weighted average method. Mean first loan into rate, first second loan into rate, total should be divided by the amount of loan, that is 12. So we can calculate the interest rate. Cessation of capitalization. Mean when we should cease the capitalizing interest cost. When we should cease? When asset is completed. After completion of the date, borrowing cost should not be capitalized. Mean we need to capitalize borrowing cost from the date construction started and the date construction completed. Before construction started date should be expense out. After construction completion, the interest mean borrowing cost should be expense out. So cessation of borrowing cost should cease when either substantially all the activities necessary to prepare the asset for the intended use or complete construction is suspended due to industrial disputes. Suppose the construction started on 1st March and construction completed on 30th September. This means borrowing costs relating to this construction date should be capitalized. How many months? These were 7 months. But suppose out of this time period, 1 month construction halted, construction stopped due to some technical errors. If construction stopped due to some technical errors, for that time period, interest cost should not be capitalized. This means we need to capitalize how many months? 6 months rather than complete 7 months. If during construction, the construction work halted, the construction work stopped due to some technical errors. Some technical errors could be like labor strike, could be late delivery of material. So for that time period, borrowing cost mean interest should not be capitalized. Let's discuss statutory understanding 7. What we need to do, calculate the total amount to be included at cost in property, plant and equipment in respect of development at 31st December. Mean we need to calculate the total cost that should be capitalized into asset cost. On 1st January 20x5, Sansco began to construct a supermarket which had an estimated useful life of 40 years. It purchased the site for 25 million. Mean land they have purchased how much? 25 million. Figures in thousand. The construction of the building cost 9 million. So 9 million is the building construction cost. And the fixture and fitting cost 6 million, and 6 million is the fixture and fitting cost. And all these should be capitalized. The construction of the supermarket was completed on 30th September 20x5. And it was brought into use on 1st January 20x6. Mean the construction completed on 30th September when it started on 1st of January. But company asset was available for use on 1st of January, and we need to charge depreciation when asset is available for use. So depreciation when we need to charge when asset is available for use rather than when the usage started and it was brought into use. Mean it was available for use from 1st January. If the current year is 31st December 20x5, will there be any depreciation for the current year? No. Why? Because the asset was not available for use in the current year. Suppose the asset was available for use on 1st of December. This means for 1 month depreciation we need to charge in the current year. If the asset was not available for use in the current year, this means there will be no depreciation. Though asset completed on 30th September, but it was not available for use on 30th September. When it was available on 1st January, this means depreciation will start from next year, not in the current year. Okay, so these costs should be capitalized and there shouldn't be any depreciation. Sensco borrowed 40 million on 1st January 20x5 in order to finance the project. And the loan carried interest at 10% per annum. And it was repaid on 30th June 20x6, means the amount repaid in next year. But we need to see how much amount of borrowing cost should be capitalized. So it was 40 million amount and the interest rate is at 10%. So this means 4 million is the annual interest rate. How much should be capitalized out of this 4 million? How much should be capitalized? From start construction date till construction completion date. What is the construction completion date? 30th September. This means from January to September should be capitalized. How many months? So what is 9 by 12 of this 4,000? 3,000. So this 3,000 should be capitalized and all together, how much is that? 43. So 43 million should be capitalized. Calculate the total amount to be included at cost in property, plant and equipment in respect of the development. So we have calculated. Is it fine? Can you understand this? Especially how we have calculated these 3,000. So this standard completed now. We will see question on this standard later on. Let's move toward another accounting standard, that is IAS 40 investment property. Property mean land and building. In simple word, property mean land and building. Properties are of two types. Used in business property. Normally we use in our business. If we are using any property in the business, so we will record as a property, plant and equipment, mean non-current assets in the balance sheet. Mean those properties that we use in our business, we classified them as property, plant and equipment in the balance sheet. But if we have any property and that we are not using in our business, we are using this as investment. Why? To earn income. Income could be either rent or could be capital appreciation. Capital appreciation mean increase in its value. Mean we are having some property, mean in business we were having some enough funds and we invested into a property, and from that property we are generating rental income, or we have kept that property so that in future the value will increase and we can earn something through capital appreciation. So that investment property should not be treated as property, plant and equipment. It should be treated as a separate asset called investment property. Though we will record under non-current assets, but not in property, plant and equipment. So any property that is being used in the business is called property, plant and equipment. And any property that is not being used in the business, we have made investment in that property to earn income. Income could be in the form of rent, or income could be in the form of capital appreciation. So that income earned property will be recorded as investment property rather than property, plant and equipment. Is it fine? Can you understand this? Suppose we are having a building for our business and there are 3 floors of the building. These 2 floors we are using in business. So these 2 floors should be recorded as property, plant and equipment. But if the top floor we have rented out, mean we are not using in our business, that floor was spare, so we have rented out to any of the restaurant and we are receiving rental income. So we should record this part of property as investment property, sorry. Where this income should be recorded in profit and loss account as an other income. Can you understand this concept? So let's see what is investment property. Investment property is land and building held to earn rental or for capital appreciation or both. Mean we held this investment for generating income either in the form of rent, either in the form of capital appreciation, mean increase in value of the asset, rather than for use by the entity, because that property, that land and building we are using in the business should be recorded as property, plant and equipment, are for sale in the ordinary course of business and we do not want to sell this property. If we keep any property for sale purpose, like we are doing a property business, so that will be our inventory, not investment property. In this property, we have made investment to generate income other than our normal business. Owner occupied property is excluded from the definition of investment property. If any property is owner occupied, he is using that property, that should not be part of investment property. That is his personal property. So these are properties not used by the entity in general operations. These could be spare properties rented out to third parties are specially brought in order to profit from gain in value. Mean we have kept this property either to generate rental income or gain in value, mean capital appreciation. There could be a situation where a building can be accounted for in 2 different ways, like some part we are using in business, some part we have rented out. So the remaining part we need to record as investment property. If an entity occupies a premises but rent out certain floors to other companies, then the part occupied will be classified as property, plant and equipment per IAS 16. And with the floor rented out classed as investment property per IAS 40. This consolidated account paragraph, leave for a moment, we will cover in consolidation. What could be the accounting treatment? As for the other assets, investment property can also be recorded either on cost model or fair value model. If we are recording on cost model, how we can record cost less accumulated depreciation, like other assets. But if we are recording on fair value model, what is meant by fair value model? Like every year, we need to check its value. Every year end, we need to check its market value. If the market value is greater than its value in the books, there will be a gain. The gain should be recorded in profit and loss account as other income. If market value is lesser than the book value, there is a loss. We need to record as loss on investment property in profit and loss account. And if we are recording this asset on a fair value model, this asset should not be depreciated. There is only one asset that is excluded from depreciation, and that is investment property if we are recognizing it on fair value model. No depreciation should be charged on investment property if we have adopted fair value method recognition. If we are recognizing it on cost model, then we will charge depreciation. But if we are recording investment property on fair value method, it is excluded from depreciation. So once the model is chosen, it must be used for all investment properties. If we are recording one investment property on cost model, all investment property should be recorded on cost model. If we have chosen to record one investment property on fair value method, if we are having 7 investment property, all should be recorded on fair value method. There is no selective accounting record adopted for investment property. So cost model. Under the cost model, the asset should be accounted for in line with the cost of a model laid out in IA 16. And what is that? Cost less accumulated depreciation. Under fair value model, under the fair value model, the asset is revalued to fair value at the end of each year, mean every year, and we need to check its market value. The gain or loss is shown directly in a statement of profit and loss account, not to other comprehensive income. Revaluation gain we record in other comprehensive income, but revaluation of investment property will not be recorded in other comprehensive income. It should be recorded in profit and loss account. And no depreciation is charged on the asset if investment property is recorded on fair value method. If we are recording on cost model, then depreciation should be charged. Fair value is normally established by reference to current price on an active market for properties in the same location and condition. Mean, what does fair value mean? Market value. As you're understanding it. So how the property would be presented in financial statement as at 31st December if a company adopts a cost model or fair value model, mean using both models separately, you need to provide how this should be accounted for. So selling a manufacturing entity purchased a property of 1 million on 1st January 20x1 for its investment potential. The land element of the cost is believed to be 400,000. Out of this 1 million, 400,000 is the land element. So remaining 600,000 is the building element. And using a cost model, we need to charge the depreciation, but on the building rather than land. Okay, the land element is to be valued to 400,000 and the building element is expected to have a useful life of 50 years. At 31st December 20x1, Local property indicates just that the fair value of the property has risen to 1.1 million. So using cost model, so property cost is what? 1 million. We need to deduct accumulated depreciation. How much accumulated depreciation? This 600,000 divided by 50 years. 12,000. So 12,000 will be eliminated. And with the remaining amount, how much is that? How much is that? 988,000 should be the carrying value in balance sheet. Is it fine? I mean, this is an investment property should be recorded in the statement of financial position with 988,000 carrying value. Now, if we move towards fair value model. So the property value we bought in 1 million, but at the end of year, its value is 1.1 million. So market value is 1.1 million. Mean 1100,000. While its cost was this, so 100,000 is gain. So in statement of financial position, it should be recorded on 1100,000. And in statement of profit and loss account, we need to record what? 100,000 as gain on profit. Why we haven't depreciated in fair value model? Because it is excluded from depreciation if we are recording on fair value model. In cost model, we don't need to consider this value up. And in fair value model, we don't need to consider its useful life and depreciation. Is it fine? Okay, now moving towards another concept. And there are two separate concepts. I'm putting a line here. Now see, this is our building. And in building, there are 3 floors. Until last year, we were using all the floors in business use. This means we were charging it as property, plant and equipment. We were treating this building as property, plant and equipment. But this year, we decided we can manage our business on these 2 floors. Let's rent out this floor. This means now this floor should be recorded as investment property and these 2 floors should be recorded as property, plant and equipment. Mean we are transferring our asset from property, plant and equipment to investment property. Or could be other way. Until previous year, until last year, we were using 2 floors in our business and 1 floor we were using as investment property, mean rental income. But now we have decided, no, we need more space for our business use. So we are going to convert this investment property to where? Property, plant and equipment. Either property, plant and equipment can be converted to investment property, or investment property can be converted to property, plant and equipment. If we are converting either of the case, what should be the treatment? Let's discuss. If an asset is transferred from property, plant and equipment to investment property, so PPE to investment. And the fair value model for investment property is used. And we have decided we will record investment property on fair value model. The asset must first be revalued per IAS 16, creating a revaluation surplus in equity. So first we need to check the market value of the asset. Before converting it into investment property, we need to revalue the asset. And before converting to investment property, it is property, plant and equipment. And any gain or loss relating to property, plant and equipment should be charged in revaluation surplus gain and loss to profit and loss account. So before converting to investment property, any of the property, plant and equipment, we need to revalue our property, plant and equipment. And if there is any revaluation gain, should be charged to revaluation surplus. If there is any revaluation loss, should be charged to profit and loss account that we discussed in previous lecture. And then transferred into investment property at a fair value, then we should charge to investment property. If the cost model is used for investment property, the asset is transferred into investment property at the current carrying amount and continue to be depreciated. Mean then the same treatment for IAS 60. Is it fine? Now, if investment property to property, plant and equipment, we are going. If an asset is transferred from investment property to property, plant and equipment, and the fair value model for investment property is used, revalue the property first per IAS 40 and revaluation gain or loss of investment property should be charged where? In profit and loss account. And then transfer to property, plant and equipment at a fair value. But if we are going to transfer to property, plant and equipment, then it will be depreciated like normal property, plant and equipment. If the cost model is used for investment property, the asset is transferred to property, plant and equipment at the current carrying amount and continue to be depreciated. So can you understand this? If we are moving from PPE to investment property, we need to revalue the PPE first. And to revalue PPE, the gain should be charged to revaluation surplus and loss should be charged to profit and loss account that we have covered in previous class. But if we are converting from investment property to PPE, we need to revalue the investment property first. And any gain loss relating to revaluation of investment property should be charged where? In profit and loss account. And then it should be recorded as PPE. Test your understanding now. What amount should be recorded in KL company's statement of profit or loss account for the year ended 31st December 2021? Meaning you need to calculate what amount should be charged in profit and loss account. KL company purchased an investment property some years ago and carries it under the fair value model. This means there was no depreciation. At first January 2021, the property had a fair value in a KL company's financial statements of 12 million. On 1st July 2021, KL company decided to move into the property and use it for its own business. Now they are moving the property to PPE. When? At 1st July. At this date, the asset had a fair value of 14 million and a remaining useful life of 14 years. How much amount should be charged to profit and loss account? Please calculate that. How much amount should be charged to property, plant and equipment in profit and loss account? Please calculate that. How much? No. The property was recognized on fair value model. Its value was 12 million. So before converting to PPE, we need to revalue its new value is how much? 14 million. So there is a gain of 2 million, and this gain should be charged to PNL. When? On 1st July. So after converting to PPE, how much value is going to be converted to PPE? 14 million. And its remaining useful life is 14 years. So 14 million remaining useful life is 14 years. How much depreciation should be charged for the current year from 1st July onward? How much is the depreciation from 1st July? This means January, February, March, April, May, June, 6 months depreciation should be charged. So into 6 by 12, how much should be the depreciation? 51? 510? 500 mean this should be charged as depreciation. So gain should be charged this, and depreciation for the year charge should be this. So net effect will be but we need to record both separate because gain and depreciation we cannot net off. The gain 200,000 should be charged to profit and loss account. Yeah, not in other companies income, in profit and loss account. This is relating to investment property. Any revaluation gain relating to PPE will be charged to other comprehensive income as revaluation surplus. But this gain is on investment property. Before converting to PPE, we need to revaluate it. So any gain loss on revaluation of investment property should be charged to profit and loss account. Investment property is having no link with other comprehensive income. Is that fine? Nothing should be recorded in other comprehensive income relating to investment property. So from now onward, if company will record this PPE on revaluation basis, then they will charge again to other companies. So in profit and loss account, this gain should be recorded and this depreciation should be recorded for the current year. Chapter almost ended. Now move towards this test your understanding tab. Can you please try this question by yourself? Everybody, please try this question by yourself. Please try this question by yourself. Online students, are you there?
Yes, sir.
Please try this question.
Yes, sir.
So that we can realize up to how extent we are understanding the concepts. And this chapter is very important in accounting. Almost every level accounting, you will use these concepts. Suppose you are going for any interview, normally interviewer ask a question from these concepts, especially relating to property, plant and equipment, borrowing cost. Show using extracts the correct financial reporting treatment. Mean what should be recorded in balance sheet, what should be recorded in profit and loss. You need to calculate all the figures. In balance sheet, what should be recorded as asset, what should be recorded as liabilities. What should be recorded in profit and loss account. Come on. So during the year to 30th September 2023, Hudson built a new mining facility to take advantage of new laws regarding onshore gas extraction. They are going to construct an asset. Simple. The construction of the facility cost 10 million. And to fund this, Hudson took out a 10 million 6% loan on 1st October 20X2. Obviously, year ending 30th September. So when it started, 1st October 20X2. So 10 million is the loan and 6% is the interest rate, which will not be repaid until 20X6. The 6% interest was paid on 30th September 20X3. Construction work began on 1st October, mean at start, when the loan was taken, and the work was completed on 31st August 20X3. This means the complete borrowing cost for the year is 10 million into 6 by 100. So complete borrowing cost is what?
6 million.
How much? 6 million. Out of this, how much should be capitalized? 11 months. This means into 11 by 12 should be capitalized. What was that?
550.
5,
50.
550,000. That should be capitalized in asset. Is that fine? 550? I think so. 550. 6% is but
Yes,
6
sir.
million or 600,000. 6% is 600,000. Sorry. So 550,000 should be capitalized. Is that fine? Okay. So remaining 50. What about remaining 50?
That is expense.
Should be expense out because they have paid this complete for the year. So 1 month should be expense out. So this should be charged in profit and loss account, and this should be charged to PPE, property, plant and equipment. Okay. And this construction facility cost 10 million should be recorded as PPE as well. In this 10 million, we need to add 550. Is that fine? As not all the funds were required immediately, Hudson invested 3 million of loan in 4% bonds from 1st October 20X2 until 31st January 20X3. So he invested how much? 3 million. At the rate of what? 4%. How much is the investment income total?
120.
How much?
120.
120,000. And out of this, how much is relating to the asset?
4 by 2.
How many months?
4.
1st October till 31st January 20X3. Mean October, November, December, January, 4 months. How much is that?
40,000.
40,000 should be deducted from this amount. So not complete 550. Out of this 550, we need to deduct this of 40,000. So remaining of 510 should be capitalized as property, plant and equipment rather than complete 550. Can you understand this? And this all income should be capitalized. There is no part left that should be recorded as other income in P&L. Is that fine? Okay. 4% bond on 1st October till 31st. Mining commenced on 1st September 20x3 and is expected to continue for 10 years. Mean useful life is 10 year where we need to depreciate the asset. This means if we see property, plant and equipment, amount should include 10 million the construction cost. That is 10 million. And borrowing cost, how much should be charged? How much should we charge? 5-10,000. Is that? So these should be extract of statement of financial position. What else should be recorded? We need to see. If we prepare property, plant and equipment, profit and loss account statement of financial, profit and loss account. So interest mean finance cost should be charged how much? 50,000. So this part we have done relating to borrowing cost. The remaining investment income. Where's 80,000? For 120,000. They took loan of 10 million. So that loan should be recorded as what? Liability. Under liabilities, they should record loan of what? 10 million. This should be under assets. Out of these 3 million, they invested and they got back. So at year end, there is no investment. What is our year end? 30th September. During year, they invested and they got back. At year end, is there any investment? No. Is it fine? Let's move to next part, very important. As a condition of being allowed to construct the facility, Hudson is required by law to dismantle it on 1st October 2023. After how many years? Currently we are in 20x3. So 20x3, x4, 5, 6, 7, 8, 9, x0, y1, y2, y3. How many years? 11 years. How we have calculated this 11 years? Anybody having doubt? When we need to dismantle 1st October 20x3. It's not 20x3, it's 20y3. That comes after 10 years of this. Yeah, 1st October, this means current year complete till 20x3. Current year complete till 20x3, 20x4, 20x5, 20x6, 20x7, 20x8, 20x9, 20x0, y1, y2, and then till 30th September, y3. How many? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11. In after 11 years, we need to dismantle. This means on 11 years, we need to discount the value. Dismantling cost. Hudson estimated this would cost a further 3 million. What is the cost? 3 million, but we need to calculate present value. How we can calculate present value? Is there any rate given in this question? Hudson has a cost of capital of 6%. This rate we will use. So let's calculate dismantling cost. 3 million into what? 1 divided by 1 plus rate. What is rate? 0.06 means 6%. Raised to power n mean 11. Can you calculate the amount? One divided by 1.06 raised to power 11. Then multiply by 3 million. How much? 1.5. Complete amount. 362. So this amount should be capitalized into cost of asset. But we need to calculate interest for the current year expense on this amount. So 1580362 into 6%. What is that? A2? Two. This should be recorded as interest in P&L. And by adding both these values, we need to record the liability. How much is that? Yeah. 48157. How much? 1675184. With that amount, we need to record the liability. Again, please. 1675184. Where this should be recorded in statement of financial position. If you can't understand this, please cover the example we covered in previous lecture of dismantling cost. So this issue is also done. This means with asset cost, we need to include dismantling cost 1580362. In asset cost, we need to include the amount. How much? Dismantling cost of 1580362. And in liability, we need to record the dismantling cost. How much? 1675184. And in profit and loss, we need to record the interest. How much? We can add both. How much is that? 94822. Mean finance cost, both should be added. Now moving towards next part. As the equipment is extremely specialized, Hudson invested significant resources in recruiting and training employees. Hudson spent 600,000 on the process in year 30th September 2023, believing it to be worthwhile as it anticipates that most employees will remain on the project for entire 10 years duration. Whether this recruitment and training employee cost should be expense out or capitalized. This training and recruitment should be capitalized to the asset or should be treated as expense? Expense. Why? Because if employee move before 10 years, this means they are not providing benefit to us in longer time period. That's why this training should be expense out. Where it should be recorded? Here. Recruitment and training cost. How much is that? 600,000. How much is by adding both these? 94822 plus 50,000. So these should be recorded under statement of profit and loss account. And now we need to discuss how we should charge under property, plant and equipment. I'm taking this as a working. Here. How much is the total of these? How much is the total of these? Twelve. 090 363 That's right. And we need to depreciate this amount up to how many years? 10 years. 10 years, because the useful life is how much? 10 years. So charge depreciation for 10 years. How much is the total depreciation? How much is the yearly depreciation? Yearly depreciation is what? So 1209036. Is that? How much depreciation should be charged for the current year? Complete. When asset was ready for use. Mining commenced on 1st September, mean when it was ready for use on 1st September. This means if current year end is 30th September, how many months depreciation should be charged? 1 month only. How much is that? 100,753. This means this should be recorded as depreciation expense. 100,753 under profit and loss account. Now look at PPT, PPE, property, plant and equipment. So property, plant and equipment cost should be 12090. 12090,363 and accumulated depreciation should be 100,753. So carrying value should be how much? 11989610. 189610. So this should be recorded as asset, this should be recorded as liabilities, and this should be recorded as expense. And this is the financial statement extracts. And we got these figures from working one. Can you understand these concepts? In all the concepts of borrowing cost, of dismantling cost, of depreciation included in this question. Let's take a break. After break, we will discuss remaining question of this chapter, and then we will move towards next chapter. Okay. So let's move towards next question. Question number 11. An entity purchased a property 15 years ago at a cost of 100,000 and have been depreciating it at a rate of 2% per annum. On the straight line basis. The entity have had the property professionally revalued at 500,000. What is the revaluation surplus that will be recorded in the financial statements in respect of this property? Can you calculate revaluation surplus? We need to calculate carrying value, and carrying value should be compared with this new market value revalued amount. So the entity cost was 100,000. And its accumulated depreciation till now 100,000 divided by how many years? 15 years. For how many years that has been used? Sorry, rate is 2%. Sorry. So rate is 2%. So 100,000 into 2%. And for how many years? 15 years. How much is the depreciation? 2,000 per year. And for 15 years, 30,000. So carrying value is 70,000. What is the revalued amount? That is 500,000. So what is revaluation surplus? What is the revaluation surplus? 430,000. Option D. Is that fine? Okay. Or if we try to make an entry, so debit asset, debit accumulated depreciation, and credit revaluation surplus. So asset cost was 100, now it is 500. So asset cost should be added by this. And whatever is the in the accumulated depreciation that we need to eliminate by debiting it. So the rest is for 30,000 evaluation surplus on credit side. Okay, number 2. What double entry will need to be made to record the revaluation of building A and B? An entity owns 2 buildings A and B, which are currently recorded in the books at a carrying amount of 170 and 330 respectively. The building A carrying amount is 170,000. Building B carrying amount is 330,000. Both buildings have recently been valued as the following, and building A value is now 400,000, while building B value is now 250,000. So in building A, there is a gain of how much? 230,000. While in building B, there is a loss of how much? 80,000. This is revaluation surplus. This is loss. Loss should be charged to P&L and surplus should be charged to other comprehensive income. But if there is any opening balance of revaluation surplus relating to building B, then this loss can be adjusted to revaluation surplus. Okay. The entity currently has a balance on the revaluation surplus of 50,000, which arose when building A was revalued several years ago. There is opening balance or valuation surplus not relating to building B, relating to building A. That will remain there. Even we need to add 230 more. Building B has not previously been revalued. This means this 80,000 should be charged to profit and loss account. You know? So the asset should be up by how much? 230 minus 80, 150. Is that? And out of this, 80,000 should be charged to profit and loss account and 230 should be charged to revaluation surplus, mean other comprehensive income. What is option A? Non-current assets should be debited by 150. Is that? 230 minus 80. Statement profit and loss count should be having 80,000 as expense and other comprehensive income should be having the valuation surplus of 230. To me, this part A is correct. What is part B? Non-current assets should be up by 150. That's fine. Statement profit and loss 30. No, there is no 30 amount anywhere. So this is wrong. Non-current assets should be up by 150 and other companies income 150. No. 80,000 should be charged to profit and loss account. Non-current assets should be up by 150. Statement profit and loss by 50. There is no amount of 50. So option A. Number 3. What is the depreciation charge to the statement of profit or loss for the year ending 31st March 20x1? Please calculate depreciation for the year ending 31st March 20x1. On 1st April 20x0, Show and Steady Company held non-current assets that cost 312 and its cumulative depreciation 66,000. So 312,000 minus 66,000. What is the carrying value? What's the carrying value? 246,000. Okay. During the year ended 31st March 20x1, Slow and Steady Company disposed of non-current assets which had originally cost 28,000 and had a carrying value amount to 11,200. Mean out of this 11,200 has been sold out. What's the remaining? To 34,800. Slow and Steady Company policy is to charge depreciation of 40% on the reducing balance method. So this is reducing balance, mean carrying value, with no depreciation charge in the year of disposal and no depreciation charge in the year of disposal. That's why we have excluded that disposal. So remaining should be charged at 40%. How much? $93,920. Is that? This is relating to financial accounting rather than financial reporting. This one. Number 4. A building contractor decide to construct an office building to be occupied by his or her own staff. They want to use building for business purpose. Tangible non-current assets are initially measured at cost. Which two of the following expense incurred by the building contractor cannot be included as part of the cost of the office building? Which cost should not be capitalized? Interest incurred on a specific loan taken out to pay for the construction of the new asset. So this should be included. Borrowing cost. Direct building labor cost. This should be included. A proportion of the contractor's general admin cost. Contractor's general admin cost These are operating expenses. These should not be charged as asset. This should not be capitalized. Hire of plant and machinery for use on the office building site. If you are using any plant machinery, their value should be capitalized. Additional design work caused by initial design error. If due to error, any extra cost has been incurred, so this should not be part of asset cost. And delivery cost in getting the raw material onto the site, gas carriage inward should be part of the cost. So these should be part of the cost. So these C and E should not be capitalized. Remaining should be capitalized. Is that fine? Number 5. The purpose of depreciation is to systematic allocation of depreciable amount to revenue. Allocate the total, allocate the cost less residual value. Cost residual value mean depreciable amount on a systematic basis over the asset useful life. This is fine. This definition seems correct. Let's see what else. Write the asset down to its realizable value each period. No, it's not that. Depreciation. Accumulate a fund for asset replacement. No, 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 no. Recognize that asset lose value over time. No, it's not losing value. That is impairment. So A is fine. Systematic allocation of depreciable amount to revenue over useful life of the asset. Number 6. An entity uses funds from its general borrowing to build a new production facility. Detail of the entity borrowing are as below. 10 million, 6% loan, 6 million, 8% loan. The entity used 12 million of these funds to construct the facility, which was under construction for the entire year. How much interest should be capitalized as part of the cost of the asset? How much interest should be capitalized? There are two types of loan. So we need to calculate the weighted average interest rate. How? 10 into 6, 6 into 8. How much is the total? 108 divided by how much is the amount? 16 million. So what is the interest rate? Can you calculate interest rate, please? 108 divided by 16. 108 divided by 16. 6.75. How much amount you have used? 12 million. So 12 million into 6.75%. How much is that? 12 million into 6.75%. 8 is 12,000. Make it 12 million. 60. 8, 10,000. So 8, 10,000 is the borrowing cost. That should be capitalized. Is it fine? Because there are more than one general rules. So we need to calculate the weighted average interest rate to apply to the borrowing and to calculate cost of borrowing. Number 7. A manufacturing entity, what we need to do to calculate, what is the deferred income balance at the end of the first year? The grant that we haven't used in current year, we need to record as deferred income. A manufacturing entity is entitled to grant of 3 billion for creating 50 jobs and maintaining them for 3 years. So out of 3 million for 3 years, every year cost should be 1 million. 1.5 million is received when the job are created and the remaining 1.5 million is receivable after 3 years. So how much business have received in current year? 1.5 million. Out of this, how much is the current year expenditure? 1. So remaining 0.5 million should be recorded as deferred income. You know, in whatever government grant you have received, out of that, the relating to current year should be recorded as income and the remaining should be recorded as deferred income. So every year expenditure is 1 million. How? Because 3 million is for 3 years. If you have received 1.5 million for the current year, 1 million is income, 0.5 million you should record as deferred income. 1.5 million receivable after 3 years, providing that the 50 jobs are still in existence. The entity creates 50 jobs at the beginning of year 1 and there is a reasonable assurance. And there is reasonable assurance that this level of employment will be maintained. So how much is the balance of deferred income at the end of first year? 0.5 million and 0.5 million, we can say 500,000. Can you understand this? Now, a company and a manufacturing company entitled to grant of 3 million for creating 50 jobs, mean if they maintain 50 jobs, mean they employ 50 people, government will provide you grant 3 million for 3 years. If they maintain 50 people employment, government will provide you 3 million for 3 years. This means out of this 3 million, what is 1 year income? 1 million. Because 3 million is for 3 years. So every year income should be 1 million. If you received complete 3 million in first year, 1 million you can record as income. The remaining 2 million you need to record as deferred income. Next year, 1 year as income, 1 year as deferred income. In year 3, 1 million as income and deferred income will be 0. That we have discussed. Okay. 1.5 million is received when the jobs are created. So government paid you 1.5 million when in year 1. And the remaining 1.5 million is receivable after 3 years. That will be received after 3 years. This means in year 1, your income, deferred income. In year 1, your income will be 1 million and 0.5 million will be your deferred income. Is that? In year 2, you will record 1 million income. Instead of deferred income, you will record receivable remaining 0.5. And year 3, you will record 1 million income and remaining 1 million as a receivable because government will pay after year 3. In year 1, you received 1.5 million. This means every year you need to record 1 million as income. But as you received 1.5 million in year 1, so 1 million you have recorded income. So remaining 0.5 million that is relating to next year should be recorded as deferred income in liability. In year 2, your income is 1 million. 0.5 million, this deferred income you have used. Remaining 0.5 million that you have recorded as income, you need to record as receivable, mean need to be received from the government. And in year 3, you will record 1 million income. But what is receivable from government? That 1 million plus 0.5 previous, so 1.5 million will be receivable. That you will receive after year 3. But every year, what do you charge? 1 million income. If suppose government paid you 3 million in year 1, you will record 1 million income in year 1, 2 million deferred income. In year 2, 1 million income, 1 million deferred income. In year 3, 1 million income and 0 deferred income. So what they are asking about deferred income balance at end of year. So that is 500,000 because you received 1.5 million. 1 million is income of current year. So remaining 0.5 million that you received in advance, you need to record as deferred income. That is relating to next year. Got it? Number 8. What should be recorded in financial statement? What should be recorded in financial statement? On 1st January 20x1, Sly received 2 million from the local government on the condition that they employ at least 100 staff each year for next 4 years. This means 2 million for 4 years. This means 0.5 million mean 500,000 every year should be your income. On this date, it was virtually certain that Sly would meet these requirements. However, on 1st January 20x2 mean after 1 year, mean out of these 2 million that you have received in year 1, you have recorded what 500,000 as income and 1500,000 as deferred income. But after year 1, however, on 1st January 20x2, due to economic downturn and reduced consumer demand, Sly no longer need to employ 100 staff. The condition of the grant required full repayment, and if you are not meeting the condition of the grant, you need to pay back full to the government. This means you need to pay back 2 million back to the government. This means the year 1, 500,000 you charged as income. Now you need to record it as expense. And this 150,000 deferred income should be de-recognized. Because you need to pay 2 million back to the government. So whatever you have recorded as income, now you need to record as expense. And whatever is the deferred income, you need to de-recognize it. So what should be recorded in financial statements? Reduce deferred income balance by 1,500. But it's half treatment. What about this? Reduce deferred income by 150 and recognize a loss in profit and loss account of 500,000 as expense. Yes. Reduce deferred income by 200,000. No, deferred income is 150. How we can reduce by 200? Reduce deferred income by 200. No, it's a 150 balance. How we can reduce 200? Because we need to eliminate that deferred income. Whatever is there, we need to eliminate. Is that fine? The option number 9. An entity purchased an investment property on 1st January 20x3 for a cost of 3.5 million. The property had an estimated useful life of 50 years with no residual value. This means if a company is recording on cost basis, so there should be depreciation. What is the annual depreciation? 3.5 million divided by 50 years life. How much is the annual depreciation? 70,000 annual depreciation. Okay. At the end of 31st December 20x5, how many years? 3 years. 20x3, 4 and 5. What's the depreciation for 3 years? 210,000. Okay. Had a fair value of 4.2 million. But in fair value, we don't need to incorporate depreciation. So an entity purchased an investment property on 1st January 2023 for 3.5 million cost. The property had an estimated useful life of 50 years with no residual value, and at 31st December 2025, mean after 3 years, had a fair value of 4.2 million. On 1st January 2026, the property was sold for net proceed of 4 million. Calculate the profit or loss on disposal under both cost and fair value model. Let's consider cost model first. 3.5 million is a cost. Annual depreciation is a 70,000. If you are disposing after 3 years, what is the carrying value at the time of disposal? Sorry, 329,000. One more zero. And you are selling at 4.2. Oh, sorry, 4. Mean 3.29 is the carrying value, and disposal value means sale proceed is at 4. Is there any gain or loss? How much? 0.71 million is the gain using a cost model. This means either option A or option D. Now using a fair value model, we don't need to incorporate depreciation. So using fair value model, the sale proceed is of 4 million, while its cost was how much? Sorry, its a value on that date was 4.2 million. The value was 4.2 million. You are selling at 2 million. Is there gain or loss? 0.2 million is the loss. So option A or D? A. Is that fine? Number 10. An investment property with the useful life of 10 years was purchased by Acon on 1st January 20X9 for 200,000. By 31st December 20X9, the fair value of the property had risen to 300,000. Acon measured its investment property under the fair value model. So forget about useful life. Its fair value is 300,000. Its cost was 200,000. So there is a gain of 100,000 that should be charged to profit and loss account. What value would go through the statement of profit or loss in the year? Gain 100,000 and depreciation 30,000. Known fair value, no depreciation should be charged. Gain 0, depreciation 30. No. Gain 100, 0 depreciation. Yes. Because if on fair value, we don't need to charge depreciation. Investment property is excluded from depreciation if measured on fair value basis. Number 11. With regard to borrowing costs relating to specific borrowing used for the construction of a qualifying asset, match the depreciation to the correct accounting treatment in the table below. Interest earned on the investment of a surplus borrowing before the construction period began. Any investment income before the construction period where it should be recorded included in calculation of non-current assets, recorded as investment income in profit and loss account, or recorded as finance cost in profit and loss account. Investment income before construction date, because between construction date to completion of construction, we need to add the borrowing cost and deduct the investment income. Interest incurred after the construction period has ended. It should be recorded as finance cost in profit and loss account. Interest incurred during the construction period. This should be added to the non-current asset cost. Interest earned on the investment of surplus borrowing during the construction period. That should be deducted from borrowing cost of asset capitalized. So chapter 2 completed now properly. We have covered everything. Now you need to revise this chapter before next class. I'm leaving today early. Hopefully next class we will start chapter 3 onward. Next week we do not have any class due to the holidays. The complete week is off. So hope to see you week next to next.
Okay, sir. Thank you.
And week next to next, our class timing will be 6 to 9. And probably we will be having 2 classes in a week, one on Monday and one on Wednesday.
Thank you, sir.
So see you again week next to next.